Hello, this is Corner Invest. Today I'll be talking about how to find high quality companies in your portfolio today. So in today's video, we'll be covering a few things. We'll be covering how to find high quality companies, why adding slowly is probably the correct approach right now, as well as some questions that you guys have left me in the comment section. So let's talk about the first metric that I have for all my different businesses. It is called the fundamental metrics. So apart from high revenue growth, high earnings growth, I also want my companies to have high ROIC as well as high margins. So let's talk about ROIC first. ROIC is your return on invested capital. So think of your return on invested capital as the returns a company can generate by reinvesting in its business. So let's say a company borrows debt at 4% and then it reinvests in its business and it gets 10%. The difference of 6% is what creates intrinsic value for the shareholders of the company. So normally when you want to buy high quality stocks, you want to look out for those companies that have extremely high returns on invested capital because they can make the difference over there, and the wider the difference, the better the returns for the shareholders. So here are some examples of companies with high ROIC over here. So as you can see, a lot of the Mag 7s, they qualify for this metric over here. So you have Apple, Nvidia, Google, Meta, Microsoft as well. Microsoft was around 24%. I filtered this at around 25%. So Microsoft has quite high ROIC as well. And normally, the higher the ROIC, the better for your company. Next metric is margins. So there are normally two ways a company can gain market share. A company can gain market share by creating an incredible product that no one else can create. So for example, let's say ASML, or a company can create a product and lower its cost to gain more market share. But what happens when you lower your cost is you will lower your margins, you will have higher market share in the short term, but this leads to commoditization of your products over time. So let's compare two companies over here, one with low margins and the other one with high margins. So let's take a look at Tesla versus Microsoft. So Tesla, they have to sell their cars at a lower price so that they can maintain their volumes over time. So if you were to look at the Tesla car prices over the past few years or so, it's been lowered almost every single year, and they are even seller financing their cars to make sure that they continually sell their cars. This is not what you want to see for all your different businesses. Whereas for Microsoft, Microsoft sells the same amount of software every single year, or maybe it increases by a single digit or so. But the good part about Microsoft is that they can increase their margins over time by exercising their pricing power. So they can increase their prices and they can increase volumes. That is normally what you want to see for all your different businesses. And that is when your businesses can get alpha above the market. So here is the side-by-side comparison of your Tesla as well as your Microsoft gross margins over time. So if you're to look at Tesla's margin, Tesla over here, the margins have been decreasing over the past few years already. Whereas if you're to compare that to Microsoft, Microsoft's margins have been steadily increasing over the past few years or so. And that is what you want to own. Not this one on the left hand side over here when the margins are slowing down. This shows a lack of pricing power, and basically what they're selling is a highly commoditized product. Next portion over here is what I call the qualitative metrics. So for qualitative metrics, there are two over here. One of it is market share and competition, and then the other one is I want companies that are operating in a monopoly or duopoly. So more competition leads to less market share, and more often than not, it will end up being a price war. So what companies will do to gain more market share in the same space is by lowering their prices. And when you lower your prices continually over time, then your competitors lower prices as well. This will lead to a highly commoditized product, similar to what Tesla has in the EV space. So you want a winner in a singular segment. You don't want a fragmented segment, like for example, your fashion, your cars, your cybersecurity, all these different industries, they have highly fragmented segments, and that is normally what you don't want to see. You want one clear winner in the space, and that is usually the company to own. So for example, over here, let's compare your energy drinks as well as your credit ratings. So energy drinks over here, as you can see, there are a lot of different players in the space. So you have Red Bull, Monster Energy, Celsius, C4, Ghost, Alani, all these different companies over here. And if you're to include all your different caffeine companies like Starbucks, like Luckin Coffee, all these different businesses over here, they make up the entire caffeine market share. And that is an extremely fragmented industry that you don't want to invest in. So if you have to compare this to credit ratings, in credit ratings, there are only three players in the space. So you have Moody's, S&P Global, as well as Fitch. S&P Global and Moody's are arguably in a duopoly, and that is what you want to have for all your different businesses, because the lesser the competition, the greater the market share, and the greater the returns for the shareholders over time. Last metric that I normally look at is the management actions. So your management actions refers to your capital allocation as well as what the management does outside of its business itself. So for capital allocation, there are normally two things that the management can do. The management can do share buybacks as well as dividends. You don't want your companies to basically do defensive acquisitions over time. So for example, let's say Adobe. Adobe has been trying to relentlessly defend its moat over the past few years. So they've tried buying Figma. They did a lot of different acquisitions over the past few years or so, simply to defend its market share in the editing software portion of their business. And that is normally what you don't want to see for businesses. Same for healthcare. Healthcare businesses, what they do to grow is they will acquire other small companies, and acquisition usually dilutes the core business itself. So let's look at AutoZone over here. So AutoZone over here is a company that just buys back its shares every single year, and that's the story for AutoZone. So as you can see, their shares outstanding has dropped by around 90% or 99% over the past 20, 30 years or so already. And if you have to look at AutoZone's returns, this is AutoZone's returns. So AutoZone has returned 4,470% over the past 20, 30 years or so, whereas the S&P 500 has returned around a 374% over the past 20, 30 years or so. So AutoZone has outperformed the markets by an extremely high margin, and AutoZone is not a phenomenal business. It is just a business that provides repair services, sells all your different parts, car parts and all that to all these different consumers over here. So it's not an incredible business, but they have executed it to perfection. All they have done is they have done a lot of share buybacks. So when you do a lot of share buybacks, what happens is your shares outstanding will decrease, and for the same earnings, your EPS will actually increase over time because your shares outstanding, which is your denominator, will decrease, inflating your EPS itself. So this is what AutoZone has been doing over the past 20, 30 years or so already, and it has turned out to be an incredible story. So for all your businesses, normally I will lean towards businesses that will allocate capital through share buybacks as well as dividends. That is normally what I want to see in my companies. Next portion over here is focused on your management actions. So I don't want my management to get too political, because when it gets too political, the actions will hurt the stock price. The actions will also hurt the brand name itself. So Tesla is a company that is experiencing this right now. So Elon Musk over here is a part-time Tesla CEO right now. So he is part of Doge. He's in the government itself, and he is also a Tesla CEO. And this is clearly hurting the brand name of the business. And his association with Donald Trump as well is causing Tesla's brand to be hurt as well. So over here, this is Tesla sales in Europe. As you can see, Tesla sales in Europe has dropped massively this year. So 60% in Germany, 55% in Sweden, 55% in Denmark as well. This is just remarkable for this business, and it will take years for Elon Musk and Tesla to repair this brand name that they have basically hurt over this past year or so. So in summary, you want to own companies that are operating in either a monopoly or a duopoly. You want companies that face little competition. You want companies with high ROIC, high margins on top of high revenue growth as well as high earnings growth. And you want solid management decisions that are more geared towards share buybacks as well as dividends, because those two actions, they are often the ones that will lead to the least mistakes. Next portion over here, I'll be talking about why adding slowly is probably the approach right now. So the markets are not pricing in any sort of economic downturn due to the tariffs. The tariffs will have impacts on the economy, but no one knows the extent yet. So on the left over here, this is a Temu purchase. So I saw this on Twitter. It's quite funny because the product itself costs around $125. And then if you add on the import charges, it basically 3x the prices that the US consumers were paying over here. So item product cost was around $125, and then the import tax itself was around $166. The import taxes was more than the product price itself, and this is just crazy for the US consumer. I don't know how long they can survive with these import taxes on all the different products that they get from China, and where else are they going to search for all these products? I'm not too sure about that. But anyways, this portion over here is from Aswath Damodaran. So this is what he said about the tariffs. So we saw the trigger event, which is the Liberation Day, and we sort of had the market reaction already, which is the down 20% or so. But the aftershocks, the real effects in the short term, as well as the long-term effects, have not been felt yet. So we will likely see the impacts coming in soon, the aftershocks as well as the short-term impacts in Q3 and Q4 of this year. That is when you will see the true economic impacts of this tariffs over here, whether or not it is inflationary, whether or not it's slowing down the economy, whether or not it will cause a recession. No one knows, and that's why I've been adding slowly into my portfolio. I think the markets are not pricing in yet because multiples are still quite high. It is not extremely undervalued yet, and we have to wait to see the economic impacts of all these tariffs. Last portion over here, I'll be talking about some of the questions that you guys have asked me on some certain stocks. So first one over here, hey, thanks for your amazing content. What do you think about Shopify at current valuations, around 130 billion US dollar market cap? So Shopify is a business that is quite entrenched in all your different small businesses. So it is basically the language for all these different small business and all these startups over here already. But for Shopify, it is simply trading at too high a valuation. It is now trading at, I believe, an 80 times earnings, and you have a similar company, not in the same space. Shopify is a bit more niched out. You have a similar company in Amazon that is trading at a more reasonable, more fair valuation, operating in the same retail segment as well. And so I think for me, Amazon is a much better bet as compared to Shopify, and it has much more predictability as compared to Shopify. Shopify is more geared towards small businesses, and when an economic downturn comes, normally the small businesses are the ones that are hit the most. And so for me, Shopify, it is a company that lacks predictability. It is not as predictable as Amazon, and it is a company that is simply too overvalued right now. Next one over here, by the way, what do you think about Reddit? No debt, a lot of cash, and they are growing revenues while investing a lot. So for Reddit over here, it is a company that just IPO'd last year, and normally for me, I wouldn't touch IPO companies simply because they are normally valued extremely high and they're often overpriced at IPO itself. So for Reddit over here, if you're to look at the metrics itself, if you're to go dig into their income statement and all that, 10% of their revenues actually come from Google. So if you're to remove that Google portion, their earnings negative, and over the trailing 12 months as well, Reddit is losing money. So for me, I think Reddit doesn't meet the criteria that I want. I want my companies to at least turn profitable first. And Reddit is a company that is trading at an extreme high valuation. So of course, if you have the conviction to hold through Reddit, then it could be a bet that could pay off. But for me, I think it's too risky a bet for me, although it can 10x from here. So for me, Reddit is an avoid. Last question over here, just wondering, do you own any speculative type names? Like not fully speculative, stuff which could 5, 10x but also flop. Hims, SoFi, Nubius comes to mind. So Hims is a telehealth company. What they do is they basically sell all your different discrete drugs and they operate under a subscription business model. For me, I think Hims is not predictable enough and that's why I haven't invested in it. Amazon is attempting to eat into Hims market share, and I think Hims, the barriers to entry is not very high. You could easily see an Amazon coming in and taking over Hims market share over here. So Hims for me is not an investment that is viable. Next one is SoFi. So SoFi is a fintech company, is operating sort of like a bank as well as a company that sells investment products. And for me, I think SoFi as well, it is more of a speculative stock, not so much the fundamentals. Of course, the fundamentals have been growing over time. And for me, I like companies with a track record of economic excellence before investing in it. So for SoFi over here, it is a company that simply doesn't have that yet. And so it's an avoid for me. So to answer your question, I don't own any speculative stocks right now. For me, I think my companies, I want them all to be high quality. I don't want any speculative names inside. As for whether or not I'm looking at some small cap stocks, yes, I'm looking at some small cap stocks. I'm looking at companies like SiriusXM. SiriusXM is a monopoly in your radio, and Evolution Gaming as well. Evolution Gaming is sort of like a monopoly in the gambling space as well. So these two companies are the ones that I'm looking at. They are high quality monopolistic companies in their individual segments. And so I don't think I'll be owning any of these hype stocks over here that everyone is talking about on Twitter. Maybe for small caps, it'll be Evolution as well as SiriusXM. I hope you guys have found this one useful and invest safe.